Hello, everyone. Welcome to a brand new episode of One Vision, Different Tech Views. This is Theo, your host for today's episode. Joining us on the show, and you're in for a treat, is Jennifer White, Senior Director at JD Power, someone who has the magic trick of being able to not pull a rabbit, but pull tons of stats and relevant stats to any conversation you can think of. And I personally witnessed that magic power on stage. So welcome to the show, Jennifer.
Oh, well, thank you, Theo, for having me. I'm excited to have a good conversation.
Good and important conversation, especially for the times we live in right now. So let's go right into it. How do we even begin to sum up the first half of this year? I don't know where to start. We talk a lot about consumer sentiment. We talk a lot about how people are reacting. What key indicators should we be looking for? What's your take?
So, at JD Power, our job is to represent the voice of the consumer in whatever industry we want to talk about. So, our job is to take what consumers tell us and share it with businesses across all industries. And the best word that I can use for banking and credit card customers and financial situations, or the best, I guess, phrase is that we're in a zone of anticipatory angst. This
Okay.
idea of, inflation, job security, government policies, housing, debt, all of those big topics are just weighing on the hearts and minds of today's consumer. What's interesting is all that weight that they feel, actual metrics around financial health status. So the percent of customers who can be considered financially healthy. Are they paying their bills on time? Do they have some kind of long range savings? Do they have access to credit when they need it? Are they adequately insured? A healthy customer, it's roughly 1/3 of the population. So we could talk about the sobering fact that 2/3 are unhealthy, but those numbers aren't changing. And they haven't really changed for the last 12 months, if not 18 months. Consumers tell me that their satisfaction with their personal financial condition, so me, how do I feel, is pretty stable. Is it gradually eroding? Sure. But when we think about all the anticipatory angst and the news media and everything that swirls around, the reality is that it's not really declining personal satisfaction. And we went so far as to even say to consumers, how stable is your personal financial condition? Is it stable and secure? Do you agree with that statement? And 41% will tell me that my condition is stable and secure. 36% feel like it isn't. And that's sobering on one hand, but on the other hand, that also isn't changing. Now we know that the vulnerable customers are going to feel it first, and they're not stable and secure. And things are very, very hard for the most vulnerable among us. But they're not even telling us that things are getting notably worse in the different ways that we measure this across the data. So, how can that be possible? How can it be possible that consumer confidence supposedly is at an all time low, but yet consumer satisfaction with where they are is kind of treading water? We know 2/3 of people tell us that they're concerned that in the next 3 months, their costs of livings are going to increase. Another third tell us they're extremely worried about recessions. But yet, they aren't changing their own markers of saying, I'm financially worse off than I was a few months ago. It's so puzzling. And that's why I can only characterize it as anticipatory. This idea that these concepts are weighing heavily on me, but I am not ready to admit that I'm not doing okay right now.
I am so confused.
It really is. It's strange consumer behavior.
I don't get it because if we look at, for example, a number of people who are laid off, right? We don't need to read economic data, but I can feel it. I can see it. Friends amongst
Mhm.
our circles, right? Who are getting laid off, who are who stay jobless for much longer
Hmm.
than I could remember, even back from the dot-com days. Showing my age, but and then you see news reports, big companies laying off 6,000 people, 8,000 people, 10,000 people. All of these are not small numbers, and we know a lot of these people are not getting rehired. In the DC area, federal workers who are laid off now driving Ubers. How I don't know how to put the two and two together. How are we not feeling that we are financially worse off? I'm missing something.
Oh,
It's
I wish there
uncertainty,
was a
right?
magic potion to this, but what I will say is that, there's this old adage, I don't know how we want to say it,
Uh-huh.
uh, every congressman is a crook except my own. Was like this old saying that I used to hear. And this is not new. Okay, so this is not current governmental affairs, right?
Mm-hmm.
It's this idea that the world could be turning sideways, but I'm still okay. That's what I think is happening in the data. Even though some people know they're not okay, they're still not willing to answer survey questions that say I'm worse off. That's what I, and it's not just JD Power data. We
Mm-hmm.
see conflictions in the economic data. We can't seem to decide whether we're in a recession or not. We can't, like, common metrics that we have used historically to help measure not only sentiment, but actual real economic numbers. It feels like in many of those instances, we can look at the same number and see it in two different ways. It's kind
Wow.
of funny. I started off the answer to your question by like areas that are causing angst, right? Inflation, job security, those types of things, housing, debt. When we ask customers, when we say, okay, wait a minute, um, your worry levels aren't very high, um, but there's indicators that maybe they should be. Kind of, we go through filters the way we do survey work. But when worry isn't high, when we say to them, well, we try to summarize, well, what's keeping you from being worried? It's almost the same answers. It's people saying, well, my income is stable enough. I have enough savings in hands. I feel pretty secure in my job. And then, while government policies was on the worry list, it's also on the comfort list for some, because some believe that where we're headed is where we need to head. So we have, I think, the polarization of the consumer base is impacting what ends up in mean scores.
I think you're absolutely right. And then there's I've heard people characterize Americans as being eternally optimistic. We always think things gonna work out just fine. It will eventually turn around. We're just in for a very short period of rough ride. Um, I hope I hope they are true. I certainly am worried, but it could just be because where I live. Um, it. What about like things around credit card debts and auto loan? Because I remember in one of the last um, recessions, if we can even call that, it was the
Mhm.
mortgage, right? It was the mortgage that tripped us up. Um, are any of those, I often, when I see products like buy now, pay later, when I see things, that seem to make sense, that seems to be okay, the first reaction I always go back to, yes, but are we loading up more credit card debts? Are we just spending now in anticipation that in the future we can pay it off? And what if we don't? Am I worrying too much? I feel like I am.
Ah, well, we could talk about the definition of too much. I think there is healthy worry to be had here. There are products that sound really good to make life easier in the short run, like buy now, pay later, that are would not be on any financial advisor's good to do list, except in very specific circumstances. We are an immediate consumption society. And as a result, there's no doubting that credit card debts are higher. What's interesting is, and I haven't looked in the last 3 or 4 months. So I'd have to go back and look closer. But the last time I checked, I don't think our true credit card default rates, though, were increasing. Meaning the true, but I'll have to go back and look. Um, the reality is that people are taking on more and more debt, but they're paying those minimum balances and they're just living with debt. And I think one of the changes that has occurred is that a lot of the mystification around bad debt management is in some ways gone away. Uh, you know, During that last mortgage bubble time frame, right? Those were the first people I knew in real life that had defaulted, or that, and the people that it happened to in my little world, they've gone on to live in pretty decent environments. Now I know that that's not the case for all, but we know that there's a lot of Gen X or Gen Zers. Gen Xers, see how I defaulted to that?
I
There
am
you go.
too.
Right. Okay. So, but there's a lot of Gen Zers and even Gen Y that are considering just walking away from those student loans because they know that the predatory rates is causing them, all the stories behind it, but the consequences for that negative decision don't somehow feel as bad as maybe they did for older people. And it's just a weird phenomenon that we're in. Um,
It's
it's
a
hard to explain.
different universe.
Hmm.
Because when I start looking at the confluence of everything that's happening around, you talked about economic uncertainty, you talked about potential inflation. I can feel it when I eat out. I can feel it when I go grocery shopping. There's no denying that. There's job uncertainty. There's student loan repayment that's coming back. All of these things, and people lose their jobs somehow. They need to find ways to pay for it. I hope people are not digging into retirement account as much. There's so many questions, so many things flying around. How are financial institutions responding? Are they doing specific things to help consumers out?
So they most definitely are. What's interesting is that in all that activity you just talked about, let's use the grocery store example, right?
I can feel it.
Oh, we all feel it, right? And this is what I mean by anticipatory angst. Worry high, change in action not so much. So, we ask questions like, what changes have you made in your daily life in the last 30 days? And the percent of customers taking any action is slowly increasing, but you would think it would be making big bumps, right? Doing
Hmm.
things like, I'm going to go out to eat less, or I'm going to not buy grapes anymore, or I'm going to put off some discretionary spending. Um, and what's interesting is when you say, what have you done in the last 30 days? Those numbers are pretty stable. It's the same list of activities and it's not increasing. It's not like more people are saying, well, I'm going to go out to eat less, except maybe in the Gen Z population.
Wow.
They tend to be taking more action. But for most everyone else, when you say, put the pedal to the metal here and tell me what you've
Hmm.
really changed, action isn't widespread. People are taking such little steps that it's not showing up in the data as being this groundswell of, you know, I'm just absolutely going to refuse to, buy grapes ever again.
Wow. Fascinating.
So, what are the
Absolutely
banks
fascinating.
doing though in that
Uh huh.
space? So, the indicators are telling us that in many ways they're rising to the challenge. So, we just released our retail banking satisfaction study. It's part of our financial health and advice. I'm sorry, our retail banking advice satisfaction study. And it's part of a whole program we have around financial health and advice here at JD Power. And the indicators in that study tell us that consumers perceive banks to be rising to the challenge. So, when we first started doing the study in this way in 2021, 1 in 5 consumers said, I'm very interested in getting advice from my bank. That number is now 1 in 4. So, in just 5 years, we've seen, and that's very interested. That's like the top box. Interest is high, but like the true top box is high. When we look at who's most interested, it's the young, which is probably not surprising, but it's the young with money and without. So the emerging affluent population, that that group that has under age 40, probably high net worth or at least emerging high net worth. Their desire for more information from their trusted bank partner is increasing over time. In those populations, we're at 40% very interested. So much even higher than the 1 in 4 I just stated, right?
Oh,
Recall of advice. When we give a little definition, we say, what does this look like? And it's advice or guidance. Here, advice just isn't like investment and retirement. This is, you know, how to save for an emergency, how to, be better about paying your bills on time, short term topics. Recall of advice in 2021 was like at 30%. It's now almost 50%. Banks are pushing more information to their customers at the same time that consumers' eyes are more open. They're more willing to like pay attention. And so we see that this general recall is higher. We know through the data that to delight a customer, having 3 or more of these kind of like value added interactions with the bank, something beyond transaction, right? 3 or more of those is what takes to truly delight a customer. The rate of that is increasing over time. And then ultimately, because I'm JD Power, I got to talk about satisfaction with the experience. And satisfaction with advice is also increasing for the industry over time. So, when banks have built things like personal financial management tools, the initial adoption rates using those types of tools, often which are AI focused, right, or AI
mhm.
underlyingly driven, uh, it, you know, usage rates aren't necessarily increasing, but awareness rates are. And JD Power's data, the consumers tell JD Power to make them satisfied with the bank. Awareness is enough right now. And I think that's because for our older customers, they might already have a system in place. So they don't necessarily need to use the bank's tool. Us Gen Xers, we might already have a spreadsheet or something, right? So
Spreadsheets.
spreadsheet, right?
Yeah.
But the fact that we know that our primary bank partner has built these makes us feel better. It makes us feel better about the future for the younger customers who may be using it, our kids, others, things like that. But we don't need to use it on our own to have increasing satisfaction. All of those indicators I just gave you, um, you know, are that I have data behind each of those that shows the consumer satisfaction with the investments that banks have made in helping them improve their financial lives, whether they've decided to use them or not. Satisfaction is actually still increasing, that the banks are doing more to get our attention.
That's good to know because as an industry, I think we got so accustomed in the last few years, especially when people say, well, banks are no longer relevant. Consumers are not paying attention to banks. And I often thought I must be old school because I still keep my bank account. There are a lot of things the banks doesn't do well, but I still trust them. I still have all my assets there. I often look towards, you know, can you finally step up to the challenge? And hearing what you just told me gives me hope that there are institutions that are stepping up to the challenge.
Now, what I will say is that there's no doubt in the data that Gen Z has less trust in
Mm.
banks than those of us that were raised that those brick buildings and
Yeah,
the
Main Street.
stodgy people telling us what to do in every little stereotype. We can go back to George Bailey and It's a Wonderful Life, right? Like all of that help build our trust, and that in many ways is eroding. Gen Z does have lower trust, but it's not like bank advice has fallen off their radar. They're putting that up against social media
Hmm.
influencers. Friends and family recommendations are still top of that list. And you know what? If that friend and family is going to be somebody who is using something traditional, that's partially what's keeping it in the mix. So there's no doubt that there is a threat. And so the more that banks can remind consumers that they have value beyond just conducting transactions. Transactions are the commodity. If there's value beyond that, then relationships can be solidified. The longer it takes for a bank to offer that value, somebody else is going to fill that gap.
I love what you just said, value beyond transactions. That's something that we've been saying for so long, right? You can't
Mhm.
really differentiate a checking account from another checking account. So what else do you have, right? That differentiate and create value for the people that you serve.
Mhm.
So if you were to give advice to businesses who are trying to understand and respond to customers' current financial mindset, which clearly can vary quite a bit, what would be the most important thing for them to keep in mind?
So there really is a three-legged stool, and I'm going to use a very old metaphor, right?
I
This
like three
idea
legs
of
stool.
balance
Mm-hmm.
between personal service, digital engagement, and marketing. And that stool has been in place for a long time, and it still needs to stay in balance. We could talk about whether or not foot traffic is up or down in branches. We actually measure at JD Power the percent of customers who believe that branches are essential versus they're it's just comforting to know that they're there versus those who just don't see any need for branches. And by the way, that last pocket is in single digits. So we can talk about how our branch is dead. JD Power data pretty clearly shows that pundits saying that they're dead might not be on target.
Mm-hmm.
We could say the same for any business. And so the question becomes, how do you balance that stool? And so that's one piece of thing. I'd want to keep everybody in mind that it's no longer a single it's not a single channel. So knowing that, what are some pieces of advice? One of the first things I think I would say is that passive communications can build trust. And by that I mean, for the marketers out there, you don't necessarily need to worry that the email open rate isn't super high. Subject lines have meaning. For the digital leadership at banks that are wondering how to use white space on their page, those scam banners that you've put in place, even if they aren't clicked on, it is providing passive reinforcement to the customer that you're there to support them in challenging times. Personal service in that space. um, the asking questions that isn't just the standard robotic, what else can I help you with today? And you ask questions like, is there something in your finances that's really worrying you, to close out a personal communication. All of those passive reinforcements remind consumers, whatever business that you're in, that there is support available for them. That links to probably my second recommendation, which is we don't think of financial institutions as being very good emotional partners. We wouldn't put them on that list at all, right?
Mm-hmm.
These times require emotion, empathy, asking more questions, listening more. We've built digital engagements, digital experiences, mobile apps and banking and in cards, all of these digital experiences, we've built them to be expedient and efficient, minimal clicks. That was how we talked about success for so long. Empathy and minimal clicks do not go hand in hand. And so, without figuring out how to soften those experiences, how do you have a value added interaction that isn't just a commodity transaction? So that's something else I would have everyone consider. Is there a purposeful pause in digital interactions that should be introduced? Meaningful friction. We see it all the time right now in how our financial institutions are responding around fraud and managing, P2P movement. You're going to try to send money to someone new, and Zelle will ask you 4 or 5 times, "Are you sure you really want to do this?" Right? That is a purposeful pause. And while it might be annoying in the moment, most consumers, if you ask them to look back on the experience versus a transactional survey that's immediately happening after that instant, and you say back to them, "Oh, was that purposeful?" They recognize the purpose of the friction. And in fact, I'll add on, because I like to throw in data. We ask consumers who have recently experienced fraud.
Mm-hmm.
So if you experienced fraud in the last 12 months, who do you blame? Because all of us in financial in the financial services industry feel a lot of blame and burden at the moment. But if you ask them with a little bit of space between when that happened, I'm not saying that that call center person who took the call in the moment didn't take some heat, but they will blame themselves before they blame the financial institution with a little bit of
Interesting.
space. So, purposeful pauses in digital interactions that help take clicks to, move beyond clicks. Those are something we should be considering. And then the last piece of advice is if you do not have something in your data set, something in your toolbox that helps you understand your customer base financial health status, I don't know that you can ever really personalize your content enough. Can you really ever personalize if you don't know, no matter what business you're in, whether or not your customer can pay their bills on time, whether they're overusing credit? Um, when we ask customers, I mentioned our advice study and how banks are rising to the challenge, but we say to consumers, like, why aren't you taking the advice? Why didn't you act on it? And when they say that they're not acting on it, it boils down to them saying it's a personalization mismatch. I don't have enough money to take this action, or that action really isn't in my best interest. And personalization is one of the buzzwords of the times, obviously. I would just ask all business to consider that if you don't know financial health status, I don't know how you can personalize and truly demonstrate that you know your customer if you don't know their ability to have any discretionary spending available to them.
It reminds me one of the gripes I always have with buy now pay later products is not so much so the product that I have an issue with is the fact that they're being doled out like candies. And here's one, here's another one. You can't afford it. Here's another buy now pay later solution, without thinking through: A, can they actually afford multiple of these relationships? And B, do they have the tools to manage all of these so they don't end up overspending, right? So managing one is easy. It's paying four, boom, done. When you have two, the dates might be different, the amount is different. Certainly when you have three, four, because most of the times consumers, they don't have just one, they have four or five. That becomes a chaos and is easy to lose sight where point in time that they might actually be overextending themselves. So absolutely critical for organizations, to your point, understand: do you know where their financial health? Do you know what they can afford? I can't, I just cannot stress that even more. You mentioned a little bit earlier the digital experience, the clicks, introducing meaningful, purposeful pauses. If we take a step back, look at the digital banking experience across different institutions, a lot of these things have become, table stake, right?
Mm-hmm.
You be able to move money from one to the other, you be able to pay bills. How best should financial institutions, especially the legacy banks, differentiate themselves when a lot of these things become commodity?
First and foremost, we recently this summer released our research in, we do it in North America. It's
Hmm.
our digital satisfaction study suite, and it's mobile app and online banking satisfaction. We do it with banks, we do it with cards, with issuers. So, and our conclusion at the industry level when we looked at the data is exactly what you just described. That you're hitting the nail on the head, that there is a lack of true differentiation, at least in the offering of features and functionality in the digital experience. So there's been this race to build it all, and at least among the largest banks, there's limited differentiation. We could talk about whether or not smaller banks are keeping pace, but at least among the larger banks. And we know that most consumers have at least two or three checking accounts with different institutions. So all of that plays into everything you just described. I could come with receipts from JD Power data to talk about. So I talked about the three-legged stool, and digital is clearly one part of that stool. And there's no doubt in my mind, and nobody could really argue that transactions themselves are often very easy or much easier to complete using digital, right? Um, so, what is it that becomes differentiation? I think it is in that value added space. So it's in this idea of new account open. So let's think about the moments of truth. I'm going to rephrase how I was going to answer your question here. But let's think about the moments of truth. There's new account opening. There's the need for advice. I'm going to buy my first home. I, set a personal goal to prioritize paying down my debt. There's different advice categories in that space. There's problem resolution. It's around, in many cases, resolving fraud. It could be around a surprise fee. It could be concerns around availability of funds. There's many things around that list, but all three of those things, so whether it's new account opening, advice interactions, problem resolution, those are moments of truth that are not commodity moments. We can do our best to try to make them commodity moments, but as soon as we do, customers know you're following a script, right? Because they are moments of truth. So in the digital race, I think the ability of an institution to figure out how to handle those moments of truth so that they don't feel like transactions, that is one of the avenues for differentiation. Now, personal financial management tools, that's one way of doing it with regards to advice. But I just listed off several other examples, right? That could be very different in terms of digital implementation. I think the second thing that I would say goes back to that personalization. When we first started measuring advice and financial health status in 2021, is this kind of packaged in our financial health and advice program. We had our key performance indicators, which are, the tipping points to delight customers. And that tipping point in those studies in 2021 was information feels tailored to fit my needs. Just like a general statement. Over time, and the way we calculate this, but over time, it's now information is always personalized. The threshold for consumer expectation for personalization is increasing exponentially, and it's increasing very, very quickly. It's an overused word. I get it. Every article that shows up in all of our inbox feeds of summaries of news of the day in financial services will have at least one a summary article around personalization. I totally get that. Always personalize is the new threshold, and not many financial institutions achieve that goal.
Yes, always. I wonder why our threshold's gone up. I think I have a few
You might,
suspects.
a few, just a couple.
Right. But you're absolutely true though, because it annoys me to no end. Talking about personalization, right? I absolutely dislike emails that come through that says, "Oh, what if we can help you expanding your footprint in the US?" Like, seriously? Did hang on. Did you not even know I'm based here? Like, come on. Those are like some simple things, right? Expand your business and do X. Well, I'm already doing that. It doesn't take a genius to figure a lot of these things out. Data is there. Obviously, we all know that data is there. Doesn't mean that they can actually make good use of it. But here's room for improvement and differentiate, because these are not commodity. I love what you just said. Moments of truth. All right. So we need to talk about AI because that's what
Of course.
everyone talks about. Apart from stablecoin, personalization, AI. I cannot let you go off the podcast without talking about AI. So where do you see the adoption of AI going in banking? Please, before chatbot, yeah, like beyond chatbots,
Oh, of course.
something fun, something different.
So, first and foremost, representing the voice of the consumer, I need to remind everyone that most consumers have no idea how AI is already being used in their financial services.
Yikes,
They
we need
know it's there.
transparency.
Yeah, they know
Okay.
it's there, but they really have no idea. Okay. And
Okay.
most consumers also, there's generative AI, there's agentic AI, you could name off the list better than I can. And most consumers also are just kind of in that I really don't know how it's being used. I feel good that it is being used to some degree. A little worried about Big Brother. That's all the old school news, right? And obviously, I think agentic AI is the current focus because of chatbots, right? It's the most easiest implementation. I think I worry that as that is implemented and consumers have those experiences, that threshold for personalization is just going to increase faster than most financial institutions can keep pace with. And so to answer where do I see the adoption of AI going? I think most of our financial institutions do not have internal data systems that have been modernized in a way that allows them to speak to each other. And as a result, the power of AI cannot be harnessed. We know this to be true because you are still getting emails that say, let's expand your US footprint, right? Like, we know it. So we also know that there's small institutions that can't transfer money to large institutions seamlessly because systems just don't talk to each other. So without modernization for many financial institutions, the ability of AI to do what it will do in other industries is somehow being held back.
It's limited. Yeah.
And so I think that that's one of the things. So when we say the adoption of AI in financial services, I feel like we're going to see pockets of speedy adoption and then other pockets where it's like, does the right hand know what the left hand's doing? And that could be damaging to trust. That's when I get worried about Gen Z. They're going to be the ones that pick that up right away. Um, the other thing I think that I would point out is that when we think about personal financial management tools, very often they're dashboards, and dashboards tell us a lot of wonderful information. They do, but they tell consumers what is, not what could be. So forecasting, safe to spend or safe to save. I like to think of it as safe to save money instead of safe to spend. Safe to spend's like buy now, pay later. But safe to save, right? Like you have extra funds available. Let's shift these over in your automatic savings, right? Like that type of implementation is still done very infrequently. Right now, most of the tools that have been built are let's categorize your spending. And if you're lucky, you'll get it compared to a norm. And that norm will be your spending the previous month or maybe that same month the previous year. That's not forecasting, right? We know the capabilities are there for all of those services. And I use these examples, they're simple examples. I get it. But I use them because those are the examples that are in consumers' faces today. And we have to make the ones that are obvious to consumers better experiences before they're going to accept something that feels very futuristic.
It, your example reminds me of one of the features that Newbank has, which is fascinating. It sounds so simple, but yet I don't see it here. Is they have the ability to, and you talked about safe to save, right? So if
Mm-hmm.
they notice that you have idle funds that's been sitting and not really doing anything, not making you money, they will provide, here you go, personalized recommendation on other products you can move the funds to so you can make better use of that pot of money than just letting it sit idle. Think about the power of that.
Mhm.
Help consumers make money, right? That's why we love Acorns, right? Set it and forget, and it just does little things in the back for us. May
Mhm.
not be a lot, but it's little things that help us make us feel like, oh, okay, at least this is something useful rather than, just something sitting there. But knowing that, doing things to help improve your financial health without you doing it, like, have to actively go and research, that's powerful.
It's incredibly powerful. Now, there's two things about that, though, right? One is that, yeah, it's a very fine line between making that suggestion and pushing product. And if, again, we have pockets of really good interactions happening and then other pockets that are really poor, it's going to raise doubt in the consumer's mind of what the goal is of making that recommendation. So that's one thing I would point out. And of course, now I was just writing down that example because I'll have to go play with it, see what's out there
Hmm.
in the tool. The other thing I think that is critical here is to be mindful of is that risk and compliance in financial services is a barrier. Um, it not all so let's use the basic roundup offering on debit cards.
Hmm.
So I spent 37.89. I'd like to take that 11 cents and move it automatically and just charge me, round up to the
Hmm.
dollar, put that money in my savings, right? That's been around for many, many years.
Yes.
And only, I think, I'd have to go back and look at my inventory, but I'm going to estimate between a third, not a half, of the largest banks even offer that.
I think, wasn't it like Bank of America that started it? And
Yeah.
then Acorns popularized it, and then other banks follow? Something like that.
US Bank has it
Yes.
now. Yeah, yeah, but it's not. But
It's
some
not
large
common.
banks, I
Hmm.
won't name names, but some large banks don't have it. And so my point is there's reasons why those offerings aren't available. And very often, one of the reasons on that list is risk and compliance. And, a safe to save or spend, however you want to do it, recommendation. Um, Probably you'll meet a few lawyers along the way.
Yikes. Yes.
Mhm.
And then there's that. We're not going to go down that rabbit hole because that would start a whole different conversation. Before I let you go, any predictions for the rest of 2025?
Every indication and data point that I have, whether it makes sense or not, when I report the means tell us that consumers are treading water. That maybe we could describe it as survival mode. I could come up with a lot of different metaphors that we might want to talk about here, right? Um, I don't see that changing. There are too many elements of today's environment that are uncertain. And for majority of consumers, that means that they're just going to try to stay in their lane.
Stay alive.
Um, yeah, yeah, stay alive, stay employed. Try not to use your savings. Try not to incur more debt. We need our banking institutions to change their messages to address treading water. In April, I asked consumers, I say JD Power, asked consumers if they recall any messages in the last 3 months about managing inflation, preparing for a recession, how to pay down debt in a recession. And in all three of those instances, no more than one third of consumers told us they recalled any message from a financial institution that targeted those topics,
I don't think I've seen any from my
right?
banks. Yeah, no,
We
no. And I have
started
more
off
than
our
one.
conversation talking about worry. Number one worry, the cost of my daily living is going to increase in the next 3 months.
Real right. So,
So if we aren't talking about those topics as an industry,
mm-hmm.
right, that hit on worry in the short run, how are we going to build trust that move of your safe to save money over to a product is actually in the consumer's best interest. So banks have been rising to the challenge. They have been. Um, I think there are some topic spaces that need some adjustment to help consumers tread water.
Can't agree more. Well, thank you so much, Jennifer, for the conversation. I can keep going because the more you talk, the more questions I have. Um, this has been delightful. It's been insightful. Always appreciate you. And until next time, hopefully we can see each other in person. And
I would love that.
it would be amazing. It will be we will all be in for a treat. Let's just put it this way.
I'd
And
love it.
then
Thank you for the invitation to come today.
you're most welcome. You are addressing something so important and something that's top of mind, not just for the industries, but for us as humans, right? What do we sit around the dinner table? What are we worried about? This is something that is personal as well as something that you're absolutely right. We need to step up even more and address these. So until next time, and for the rest of our listeners, thank you so much for joining us for another episode of One Vision. We'll talk to you all next week.